Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from EU tax reforms to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. Check out PwC's Policy on Demand news platform that provides in-depth insights and analysis on tax policy developments. Policy on Demand is now available for free at policyondemand.pwc.com. On this week's episode of Cross-Border Tax Talks, we're at PwC's EMEA International Tax and Legal Academy in Madrid, Spain, where I'm excited to be joined by Edwin Visser. Edwin is PwC's European tax policy leader. Prior to joining PwC, Edwin was the Deputy Director General for Tax Customs Policy and Legislation and Director for Direct Taxes at the Dutch Ministry of Finance. Edwin, welcome to the podcast.
Thanks for having me, Doug.
So Edwin, before we dive into EU taxation, and we certainly have a lot to cover in this 30 to 35 minutes, an important first question. French fries, chips, frites, frieten, how do we say French fries?
Yeah, friet in Dutch. Yeah.
Frites in Dutch, okay. What is your go-to topping for French fries?
Yeah, I'm a mayo kind of guy, but with a Swiss twist in it, a bit of mustard in it. But,
Okay, that's
yeah,
like the Swiss version of
the Swiss version of
mayo?
mayonnaise. Yes.
Okay.
Yeah.
All right. Well, for my listeners that have seen the movie Pulp Fiction, I think it educated a lot of Americans that the Dutch enjoy mayo on their ketchup. And visiting Amsterdam and the Netherlands many times, I can confirm that. But I will say that I'm a ketchup guy. But when I'm in the Netherlands, I go with mayo. But apparently I need to try the Swiss version of the mayo.
You should, yeah.
All right. So some important cultural stuff for our listeners. So let's dive into...
Might be helpful when we discuss the European agenda on tax. Yeah.
All right. I had a feeling you might be more comfortable with that topic. So,
Yeah, maybe.
So
Yeah.
let's dive in. So we have a whole lot to cover. And I think, Edwin, one of the real challenges for taxpayers and advisors is just the sheer volume of proposals and changes that we're seeing, not just in the EU, but around the globe. And so really wanted to spend some time with you today, just kind of providing almost a highlight reel, if you want to call it that, of various EU tax initiatives that listeners should be aware of. And I think it's important that our listeners understand that these proposed, some of them proposals, some of them actual law that's going to be implemented, is really relevant for anybody that operates in the EU, whether you're an EU parented company or parented somewhere else and operate in the EU.
That's true. This is not confined to EU companies. This has a broad impact on all companies. Yeah.
All right, so let's start our flyby with the country-by-country EU directive. Tell us a little bit about that, and I think importantly, listeners who've been frankly spending a lot of time thinking about country-by-country reports in the context of Pillar 2, which we'll cover a little bit later in the podcast, Pillar 2 specifically in the EU, but the need for taxpayers to publish that in the EU. So tell us a little bit about that.
Yeah, the directive has been adopted. It needs to be transposed, like every directive, into national legislation of the member states. That has to be done by the end of June this year.
So June of 2023.
June of 2023, yeah. Romania is a bit ahead of the game. It already has transposed the directive into national law, and in Romania the obligation to publish will start on January 1 next year. So that's a bit earlier than the directive requires. So what the directive requires is the publication of disaggregated data for all subsidiaries and branches in EU member states, but also for subsidiaries and branches outside the EU if those subsidiaries and branches are in a blacklisted country. That refers to the blacklist that is published every half year by the European Council.
And when is it required for EU companies to actually disclose and publish?
As of for most companies, when they have their fiscal year the same as the calendar year, as of January 1, 2025.
Okay. And so I think what's important is that I think many taxpayers are spending additional time with their country-by-country reports in the context of Pillar 2, thinking about the safe harbors and making sure that they have qualifying country-by-country reports. And I think this is just another reason for taxpayers as well as advisors to really spend some time with the country-by-country reports and understanding that those are going to be disclosed and ultimately published.
They will be published, yes, absolutely. And it's for corporate income tax only, and not for all taxes, but corporate income tax only.
Okay.
So that may be a good nuance to add to this.
Okay. So we'll see how that potentially influences taxpayer behavior, but certainly something to keep an eye on.
But like Pillar 2, you have to start thinking about this now, and get your data together, to get your data right in order to be able to publish. And what's more important, I think about your narrative. Just publishing data, I think, can be risky because data only can be misinterpreted, I think, by many people. So that's also the message to clients by us: get your narrative on your tax strategy, your tax position, get that in order, because that's the voiceover is very important with the data that you will publish.
Yeah, and that the data point has been obviously a really big topic of conversation here on the Cross Border Tax Talks podcast, specifically related to Pillar 2.
Yeah, absolutely.
And it's an equal challenge for taxpayers that are trying to do those country by country reports and really having that process. And I do think that this publication requirement, in addition to the safe harbors with Pillar 2, is going to cause more companies to spend a little bit more time and diligence making sure, again, they're qualifying country by country reports.
Yes. Yeah.
Okay, so let's talk about kind of something else that I think is even more relevant is the Carbon Border Adjustment Mechanism. Is it CBAM, CBAM?
Yeah, that's the acronym, and what you will see is that the European tax policy agenda is full of acronyms. We'll get back to BEFIT and DEBRA and all the stuff later on.
Lots of acronyms.
Lots of acronyms. But I think CBAM is important to touch on shortly because it's imminent. What is CBAM? That's a mechanism that is aiming to prevent carbon leakage from the EU to non-member states, so third countries. And what the mechanism will do, it's called a mechanism, it's a euphemism, I think, for tax, or levy, will do is tax products that will enter the EU and that have a certain carbon content with a certain levy. And part of that levy will be an own resource for the European Commission to fund its own activities, for example, the Resilience and Recovery Package. We'll get back to that when we talk about Pillar 1. I assume we talk about Pillar 1 later on. And in October 2023, it's important because then the reporting obligation starts. The effective payments, the cash out payments, will start only as of January 1, 2026. So there's still some time. But here again, you have to get your act together to prepare for gathering the data to make sure you know what products will fall in scope of this CBAM levy and how to report. So that is, I think, the important message on CBAM.
Okay, yeah, an import tariff. I'm not sure how many that was on.
Yeah, the Commission is quite confident that this is compatible with the WTO rules, but let's see.
Okay.
You can have various opinions, like all legal opinions, of course, but
right. Yeah, that is a common topic for some of the various
Yes,
U.S. initiatives,
absolutely.
as you well know, on WTO compatibility. I think
there are some issues. Yeah.
I think if there's one thing that we know is that takes a long time to litigate.
Yeah.
A really long time to litigate. Okay, so moving on to FSR, again, in our alphabet soup of acronyms, or the Foreign Subsidies Regulation. Tell us a little bit about FSR, and we've spent some time, although I think many episodes ago, talking about EU state aid, but give us a little context of what the about what the FSR is.
Yeah, EU state aid is a nice segue into the Foreign Subsidies Regulation. It's a regulation that's important to distinguish from a directive because it's directly applicable in the member states. So it doesn't need to be transposed into domestic legislation. And it will apply as of 12 July this year. So very short time to prepare for this. And what is it? It's in fact the EU applying the EU stated framework to financial contributions provided by non-EU countries, of which the proceeds are used for investments in the EU. That can be an investment in an asset, that can be a deal, it can be a merger, it can be a takeover. And in some cases there's a notification obligation, so you have to notify that you have received some subsidies, and it can be any form. It can be a tax incentive, it can be a grant, it can be a loan. There's a very wide scope of the definition of financial contribution. And it's important because the Commission is having some powers to apply redressive measures to companies. That can be either paying back part of the subsidy, that can be by asking the company to sell a bit of the business, for example, they took over, because otherwise the level playing field will be distorted. So the ramifications are, I think, potentially enormous. I think this regulation was written against China in the past, because China provides lots of subsidies and tax incentives to companies, and those incentives are also used for investments abroad. Now this has an impact, I think, on the US too, and US companies using the incentives and subsidies of the Inflation Reduction Act.
So some of the green energy credits.
The green
for
energy
example.
credits, for example, yeah. So you have to carefully analyze, have you received a subsidy, any financial contribution? Is there a link with the investment in Europe? It can be a takeover. And for example, when you're doing a takeover and you have to analyze this data for a 5-year look-back period. So you have to look back 5 years if any proceeds that you received from the foreign government are used for this investment in Europe. So that's quite a challenge for the deals people, but also for the people working on the Inflation Reduction Act, for example.
And what are the consequences if a taxpayer is doing a deal and they have taken advantage of certain incentives as defined by these FSR rules? Or what are the consequences for taxpayers?
Well, one of them is that you could end up in a situation where you have to pay back part of that incentive. Not to the US government, but to the European Union.
Right, and I think that's what is frankly a little bewildering and concerning, I guess, as an advisor and for taxpayers, is that if they have received if they've received an incentive from some other foreign government, and they're one of these triggering mechanisms, so a deal, I think you had mentioned, would be one of the potential triggering mechanisms, then it could...
For example, yeah, but the Commission, paying back the subsidies one measure, but also the Commission can ask, to reduce the capacity of the company or the market presence of the company in the European Union. So there are various measures, but it's really impactful, I think, for certain situations. So for all companies investing in Europe, I think this should be part of the conversation when we talk to those clients.
And how do taxpayers know what incentives could potentially be triggered? Because there are obviously all kinds of incentives. You mentioned the green energy credits from the Inflation Reduction Act, is like foreign-derived intangible income, for example. You mentioned some of the incentives in China.
Those are very good questions, and we don't know the answers yet to that, I think. The scope is very wide, so any financial contribution could be in scope. So even maybe FDI, FDI, but we're not sure yet. So and in the pre-notification procedure, that means that we have a conversation with the client, with the Commission on the deal that is coming up, and whether there's a issue. So that has to be developed, I think, the further interpretation and definition of what exactly is a financial contribution that is in scope of this regulation.
And what can we expect? Will the EU provide a list of certain incentives? Or, I mean, what can we anticipate?
That would be great, but I'm not sure yet. What I know, what we hear is that the Commission is building up a fairly large team to deal with this, so it's taken very seriously. So if one company would hope, this would not be applied, then I think that would be vain hope. So this is a serious topic for the Commission, and it should be a very serious topic for us when we have client conversations with non-EU clients who are investing in the European Union.
Okay, and when did you say that these rules become effective?
12 July this year.
12 July of 2023.
And 12 October 2023, the notification requirements enter into force. So it's really, really short term.
Timely for both taxpayers and advisors to understand this and understand the potential risk. And you do wonder, will it potentially impact deal value?
Absolutely, and only at PwC we only realized, I think, later in the process what impact and what ramifications this regulation could have on clients and on investments. Certainly when the IRA was legislated in the US, it exacerbates all the ramifications and the consequences of this regulation.
Right, and I mean, I keep mentioning Pillar 2, but the U.S. certainly believed when they added these additional green energy incentives that was incentivizing U.S. taxpayers and non-U.S. taxpayers to invest in the U.S. I think that obviously was not on their minds that both under potentially Pillar 2 and now with this FSR, that those incentives could effectively or economically be clawed back by other jurisdictions.
Yeah, and that could create tensions, I think, between the US and the European Union, like applying the UTPR, but we'll come back to that later, to US companies, to US multinationals.
Right. Yeah, and we've definitely spent some time talking about that, and we saw, with the DST in France, how at least the prior administration, the Trump administration, imposed tariffs on France, and
except on champagne, I think it was.
Except French wine was excluded. So I think those were excluded from the tariffs. But you do wonder that with between Pillar 2, FSR, that, if that could be on the, additional responses by the U.S., similar to what we saw with the French DST,
Yep.
could be on the horizon.
Absolutely, absolutely.
All right, so the Anti-Tax Avoidance Directive, apparently we're on ATAD 3
Yeah.
now, and it's referred to as the Unshell Directive. What is ATAD 3, Edwin?
Well, there's a whole lot to tell about that, I think. It's a draft directive that was published last year, and it aims to combat the use of shell companies in the European Union. That's important to make this distinguishment, because we'll talk later about SAFE, and that's an initiative aimed at combating shell companies outside the EU. This is for shell companies inside the EU. And the draft directive, as we have seen it and we commented on as PwC, had quite a complicated substance threshold test to establish whether a company is a shell company or not. And if one would conclude, even after rebuttal, that the company is a shell company, there are some consequences. One of them is that there is a reporting obligation, but also there are tax consequences to it. So a tax residence certificate can be denied by member states. That's what the directive said. We think and believe this is not compatible with the treaties that countries concluded. And some treaty benefits could also be denied. That was the idea. Some benefits connected to the Parent Subsidiary Directive, to the Interest Royalty Directive could also be denied. So a whole host of tax consequences. There was a lot of comments on the draft directive. Mainly also the complication of the complicated substance test, but also it didn't make any distinction between SPV shell companies mainly used for gaining tax benefits and special purpose vehicles you have in a company or in a group for legal reasons, for commercial reasons, whatever you have. So that was a big comment, I think. So the Council, because the Commission, that's the mechanism it works, how it works in the European Union, the European Commission proposed the directive, so it's now in the hands of the Council, and the Council, that's the gathering of the Ministers of Finance of the Member States, are now in the working groups discussing a revision of this draft directive. And what we hear is that the substance test will be changed, will be a little bit different than the ones we have seen in the draft directive. There will be tax consequences. We hear various rumors about it, so we're not sure what we will end up with. And there will be a reporting obligation. Timing-wise, we don't expect this to enter into force before January 1, 2025, while the original directive aimed at being implemented at January 1, 2024. And in the proposed directive, there was a two-year look-back period, and now we're hearing that there's only a 1 year.
Okay. And how do they define a shell company? What is a shell? Because you had mentioned that there were comments provided by PwC as well as others on the substance requirement. But generally, what is a shell company?
Yeah, I think it was quite a broad definition. If you are below some substance requirements, that could be payroll levels, that could be people, that could be having an office, etc., etc. That you're quite easily, labeled as a shell company under the definition. There's a rebuttal in the original directive, but there were no criteria for that rebuttal. So I think you were sort of in the hands of the tax administration, who says, well, we think, you're still a shell company or not. So that was a vagueness, I think, that that's not good tax policy, because you need to provide as much tax certainty as you can, I think, to taxpayers.
Yeah, I think one of the things, a common theme that we see amongst policymakers and others kind of outside of those of us that practice international tax is, frankly, maybe a lack of appreciation for the fact that oftentimes investors want to set up a legal entity as an investment vehicle, so that they can rather.
For example, yeah.
For example, and it's referred, I think commonly an SPV, a special purpose vehicle. It has negative connotations, but it's really a group of investors that are putting together a legal entity to then invest in something else. And by its nature, it may not have any substance other than acting as the investment vehicle to then invest in other, for example, European or other subsidiaries. And it sounds like that's just one example that could potentially get caught up in these rules.
Yeah, for example, real estate investors in Europe, for example, from outside the EU, they often have their substance, their staff in one entity, for example in Luxembourg, and they have special purpose vehicles, propcos, per property,
Right.
which do not have staff or anything else. So then this directive would have as a consequence potentially that you would ask and require those businesses to reallocate their staff to the various prop companies, in order to meet the requirements of this directive, while having a property company per investment is not
Right.
predominantly tax driven. So that is really a consequence that we addressed also in our submission to the Commission. Hopefully this will be addressed in the revised directive, but we're not sure yet. It's apparently quite complicated. The Swedish presidency, we have rotating presidencies in the European Union. Right now Sweden is the president of the European Union, is working on a compromise. We hear that there will be some informal discussion maybe in May on this revised directive, but it will not be finalized, we think, under the Swedish presidency, but under the Spanish presidency, who will take over the helm as of July 1 this year.
Okay, so July 2023, we have the change from Sweden to Spain. And remind listeners, because we saw this, we followed very closely the EU directive for Pillar 2, but maybe remind listeners kind of what is required to be able to get a directive, because I think we need unanimous consent from the EU for the directive to get passed, and then I think you had mentioned earlier each jurisdiction has to actually go through their own legislative process to enact those rules.
Yeah, you have two legislative procedures in the European Union. The normal one that requires qualified majority voting, including a majority of 65% of the inhabitants of the European Union.
Okay.
And you have the special legislative procedure. That's for most tax legislation, and that requires unanimity by the member states in the Council.
And does the ATAD 3, the unshell, fall in the second category, requires the unanimous consent?
But for example, we talked about public CBCR. That was an amendment to the accounting directive, so that was decided upon by qualified majority voting.
Okay.
And that's what you see the Commission trying to push the limits on, trying to get tax legislation under the normal legislative procedure, so that you only need qualified majority voting, which is much more simple, I think, to get a directive adopted in the European Union.
Right.
But there's always some resistance from member states to that.
Right. Okay, so let's move on to BEFIT, which is Business in Europe, the Framework for Income Taxation. And is it a fair characterization to call this the CCCTB 2.0 or the Common Consolidated Corporate Tax Base? Is this really the next generation of that, or am I oversimplifying
No,
things?
you're right. This is the CCCTB resuscitated, I think.
Okay.
But I'm not sure this attempt to resuscitate will be successful.
So why don't we start with what
Maybe
was
get
the...
back a
let's,
little bit.
Let's
Yeah.
back up. What was the CCCTB? Because I remember, I've been doing this for almost 25 years, and I think it was around 2000, you can correct me, is where there was this discussion in the EU about a common tax base.
Yeah, that's exactly what it is. One tax base for corporate income tax in the European Union on a consolidated basis. And then the second leg of it is, of course, how do you allocate this consolidated profit to the member states? And that was based on a formula: assets, staff, etc. The very traditional.
Right. What we see in the U.S.
criteria.
in state tax
Yeah,
oftentimes.
yeah. So a lot of resistance by member states at the time, I think.
Do I have the timing about right? Was it early 2000s?
Yeah, a bit later, but
Okay.
it has been pending for a while, and
Okay.
it was never. The Commission was never successful to get unanimity on that one, and mainly because many member states, lost quite a lot of revenue. So national parliaments
Right.
of a number of countries pulled the yellow card. That's a certain procedure, and said, well, this is not going to happen. So CCCTB is that, but I think the Commission has now been inspired by Pillar 1, Pillar 2, because there, you use financial accounting to determine the tax base.
Yeah, it's a
Pillar
common
1.
tax base for sure.
It's a common tax base, and there is a fractional apportionment in Pillar 1 for excess profit. So that inspired the Commission, I think, to come up with this BEFIT, and the aims are sort of commendable. Reduce complexity, make life easier for business. But
that sounds good in theory.
That sounds good in theory, but with such an overwhelming EU agenda and all the complex changes taxpayers have to deal with, I think this is adding to complexity instead of reducing complexity. And what it also does is that you have a third system of allocating profits. We have the arm's length principle, We have formula apportionment under Pillar 1, if that ever happens, for excess profits, and then we have BEFIT with its criteria for allocating profits within the EU, but for transactions between subsidiaries in member states and subsidiaries in non-member states, you still need to apply Pillar 1 and the arm's length principle. So it's adding to the very complex landscape. And I frankly think taxpayers, our clients, but also tax administrations are not going to be able to cope with this. It's too much at the same time.
So where are we on the process? This is just a proposal, and they've sought.
No, there's a call for evidence.
Okay.
We reacted briefly on that as PwC, and we expect a proposal in October.
So what is the difference between what is a call
for evidence?
A call for evidence, and then talk a little bit. How does that process work? Because many of these have already been through.
That's normally a very brief note, 2 or 3 pages. Sketching what is the issue, what's the question we have, what are the aims we have. To refer to them, reducing complexity, making life easier for taxpayers, providing more certainty, and what are the policy options. And then they put out a submission, and so everyone
And
can...
who's they?
The Commission, sorry, the European Commission, let's be precise.
Yeah.
On the website, Have Your Say website, and everyone can react on that consultation request. And from Global Tax Policy, we, as a principle, by default, we react on all consultations of the European Commission on taxation.
So we start with the consultation.
Yeah,
and then
that's the call for evidence, and then, well, the next step will be a proposal for directive, and there need to be an impact assessment, to underpin that directive, and we expect that in October.
Okay. And then, assuming this would need to move forward, going back to our prior discussion, for this to become law, we would then need this proposal to then move into a directive, and you would need unanimous consent, presumably, for this?
Yeah. What we hear in Brussels is that, there is skepticism by many member states, also driven by the fear that they will lose revenue, but also, driven by the fact that this is too much at the same time. And that's what we also said, let's wait and assess, the impact of Pillar 2 first before we start a new adventure, because this is, well, let's try to find a polite word for it, but this is too much at the same time.
Oh, yeah. Well, that was one of the concerns, and going back, several years when, even a couple years as Pillar 2 started to pick up steam, we had the Anti-Tax Avoidance Directive, frankly, 1 and 2 in the EU with some of the interest limitation rules, CFC rules, anti-hybrid rules, and we never really let the dust settle on that before Pillars 1 and Pillar 2 came in.
Yeah,
and a lot of those initiatives, particularly under ATAD 2, had the very similar policy objectives as Pillar 2.
Yeah.
I'm not sure we'll ever know sort of that economic. I guess we'll have a couple of years of potential economic impact from a tax perspective, knowing what was the consequence of ATAD 2 before Pillar 2 came in. But just seems like a lot of new initiatives trying to address the same thing without, and again, this isn't just unique to the EU, but particularly with BEFIT, just seems less,
And again, what we understand, that the speed to come up with a proposal is driven by the need for own resources, because the EU leaders agreed on a very extensive, huge resilience and recovery package in 2020 of 750 billion euros, and that needed to be funded by own resources for the European Union. So first you had the idea to use the digital services tax for that. That idea was abandoned, then digital levy. Now they're counting on Pillar 1. As the additional revenues will be the own resource, but I think, as that will not happen, they need other ideas for their own resources, and this is one of them.
It's a great practical point.
It's a great practical point, but it's...
Yeah, but like the point that, listen, governments need money, and so they are going to continue to look to new and additional initiatives to try to raise those funds.
Yeah, but governments get money, and countries get money. This is additional. The European Commission, the European Union needs their own resources, and that is quite new. And that creates a new dynamic in the European Union.
Fair point. In other words, just to state that back, that each country has its own fisc, obviously, and its own financial obligations, but now this collection of countries also has to fund the EU, right? This larger body, it's a collection of these various, and so not only do individual countries need to raise the money, but these individual countries effectively need to raise the money to be able to support and fund the EU, or the EU otherwise needs to collect that money.
Yeah, now we even hear rumors about a toll tax for certain companies. A rumor about a crypto tax is floating in Brussels.
What's a toll tax?
That's a tax on certain infrastructures, technical infrastructures, We don't know yet much about it, but that's some rumors that are floating in Brussels, also in the context of how can we find own resources for the European Union.
Got it.
And that will make the landscape even more complex than it already is.
Okay. Well, we'll certainly continue to keep an eye on this with BEFIT.
Yeah, absolutely.
We'll see if it goes the same direction as the CCCTB, or if this will continue to move forward. All right, so the next one I wanted to move to was the acronym that they refer to as SAFE, which is Securing the Activity Framework of Enablers. It seems like in the spirit, kind of following sort of U.S. Congress with GILTI and our BEAT regimes, kind of these forced acronyms. So Securing the Activity Framework of Enablers. So what is SAFE, and what does that mean, Edwin?
Well, as I said before, this has the origin in the idea of combating the use of shell companies outside the European Union. And of course, the European Union doesn't have any jurisdiction outside of the EU. So that's hard to combat shell companies from a legal point of view. So
for those shell companies that are outside the
outside
EU.
the EU.
Yeah.
So they come up with this idea. It's not the idea to regulate the tax profession, but it's the idea to regulate certain activities of enablers. And I find enablers a very ugly word, I must say.
Agreed.
Intermediaries would be appropriate. Right. So again, here we saw a call for evidence with 4 options in it: a due diligence procedure, an EU registration, and a code of conduct. There's a 4th option, but that's less important.
Okay.
So, and every option hinges on the ability to come up with a definition of aggressive tax planning. So planning that is legal as such, but undesirable. That's how I frame aggressive tax planning.
Okay.
So we did a very in-depth analysis and said, well, any definition of aggressive tax planning, which in itself is legal, so any definition is against the principle of legality. So the Commission is now thinking of getting to an ex-ante definition of aggressive tax planning, but also to come up with a list of arrangements that would fall into scope of aggressive tax planning. It would apply only to tax advisors outside of the EU, so not to lawyers, not to asset managers, not to fund managers, so only to tax advisors,
Okay.
only outside the EU. And the Commission said in some conversations they think of creating a list of more than 10,000 arrangements in the next few years. As a consequence, if you would advise as a non-EU tax advisor on these arrangements, you would be deregistered from the register, and clients using that advice could also get penalties. So it's not only important for PwC and the likes, but also for companies, because they could get penalties using tax advisors that are not in the register or using arrangements that are on that list. That's what we hear right now.
So where is this in the process, and what do we expect for timing?
We
on
expect
this?
a proposal in June, maybe a little bit later, and we hear that the proposal will be done on the normal legislative procedure, so that will just need qualified majority voting.
Okay, because it's not really a income tax.
Yeah, you can debate whether that is
Okay.
or not, and probably some member states will be against that, so let's see how that works out. What's important to understand too is that the Commission has only limited time to agree upon this with the Council and the Parliament, because the mandate of the Commission ends in May or June next year, because then there will be elections of the European Parliament, and so there will be a new European Parliament and a new Commission later on in 2024.
Yeah, so how does, just I want to double click on the elections that you had mentioned next year. How does that work insofar as how does that impact sort of the direction of tax policy and initiatives with respect to those elections?
Yeah, what we see if we look at predictions, and every citizen in the European Union can directly vote for the European Parliament. Around 700 seats in the European Parliament. Bigger member states have large representation like Italy, France, Spain, Poland, not to forget. And what we see in the predictions, what they're worth, is that we see a slight shift to a more center-right parliament. That doesn't always mean that we'll end up, with different tax policies, because some of the center-right and right-wing parties have really progressive economic agendas and tax agendas. So that is difficult to predict right now, how that exactly will look like. But I don't expect a really big change, if I see the members of parliament who are likely to be elected and have the ambition, to continue in their positions, for example, as the chair of the FIS committee, I don't think, the direction of travel and the tone of voice in the parliament will really change.
Okay. So I do want to get to Pillar 1 and Pillar 2, but maybe one other. You had mentioned DEBRA. What is that, and where are we related to that?
DEBRA stands for the Debt Equity Bias Reduction Allowance. So in fact an allowance on equity, but it's financed by getting, stricter interest deduction limitations. That's in short DEBRA. Strange idea. Certainly if you have BEFIT floating around, because I would say DEBRA would be part of BEFIT.
Right.
But it's going to cost member states a lot of money. For example, the Netherlands, because the Netherlands has more stricter interest limitation deduction rules than other countries. So it cannot finance the allowance for corporate equity. So what we hear is that this is sort of dead in the water.
Okay. The irony that I always thought with DEBRA is the policymakers effectively allowing an interest expense deduction on equity, which feels a bit like a hybrid type deduction where you're getting a deduction on equity. I certainly understand the policy of...
Yeah, if you think you only want to tax economic rent, then it makes sense, but it's a budgetary bleeder for many countries.
Right.
Yeah.
Okay. All right, so let's move on to Pillars 1 and Pillar 2, specifically from an EU lens perspective. And we know that from a Pillar 2, which we'll come back to, we've got a directive passed, and now we're anxiously awaiting jurisdictions to implement those rules and see what those look like. But where are we on Pillar 1 in the EU?
That begins with the question, where's the OECD on Pillar 1? And they're still aiming at a multilateral convention, I think, but I think we all know and understand, the US will never sign up to this. Certainly if you look at the most recent letters of Jason Smith, the chair of the House Ways and Means Committee.
From Missouri.
Your home state. Home state, yeah. I think so Pillar 1 is dead from my point of view. But getting back to the EU intends to legislate Pillar 1 via a directive. And there's not much more to say about that, I think, from a EU perspective, per se.
It does strike me as a little bit ironic in that the point being, well, if the EU or if the US will never sign up, then this doesn't make sense. And when the US had clearly signed up for Pillar 2, we still didn't actually implement, nor will we implement, at least with the current
that's true.
with Congress. I think that just a tremendous amount of complexity, obviously, with Pillar 1. So we'll obviously continue to follow it, see what happens with the OECD. But appreciate that the likelihood of that, it does feel like it's a bit on life support at this point.
Yeah, and I'm not sure, because the Commission will never admit it, that BEFIT may be driven also by the understanding of the Commission that Pillar 1 will never happen, but, that's just guessing. Just guessing. Yeah.
Okay, so then let's move to, certainly last but not least, one of my favorite topics is Pillar 2. So we had the EU directive, a lot of drama and news that for listeners of the podcast with Poland and Hungary, the EU directive obviously passed and made for great listening for my fellow tax nerds.
Absolutely, yeah. It's sort of great entertainment.
It was, just, looking at all the tax periodicals every day, figuring out what was going on and what had Poland said, what has Hungary said. And it was almost a surreal experience. But the EU directive is passed. We are now waiting for countries to publish, ultimately propose, and finally enact their particular rules. But there's been a number of questions with respect to the compatibility of Pillar 2 and EU law. Treaties come to mind, and we'll talk a little bit about trade tensions. But what are your views on that? There's been a lot of ink spilled, and I think some very technical positions, particularly with respect to the undertax profit rule, and how that may apply within the EU. But what is the current state of thinking on the compatibility of Pillar 2 and EU law, given that we already have a directive passed?
Yeah, that's, I think, a very important fact. We already have a directive passed, I think, so that will make the likelihood that the European Court of Justice will say that there is an incompatibility less likely, I think. But that's just, an opinion. Mm-hmm. There's some articles floating around, for example, of our colleague Arne Schnitger on the phase-in clause in the directive. Is that compatible with EU law? ? Read the analysis, I would say. We don't have time to dig deep into that. There's also an issue, and the opinions vary, of course, whether the undertax payment rule is compatible with the treaties. Well, and I think this is at odds, the undertax profits rule with Article 7, Article 9 of the OECD Model Convention, which only allows you to allocate profits to a jurisdiction within the boundaries of the arm's length principle, and not beyond that. So there's a real issue, I think.
And what is the process, kind of that legal process for taxpayers, if they were to contest, or how does that work in the EU? Sort of how does the process work to determine whether something may violate?
That's interesting. Well, when you talk about incompatibility with the Treaty for the Functioning of the EU, then it's the procedure that you can end up, with the European Court of Justice. But when you talk about incompatibility with the tax treaties of member states with third countries or member states, then it's the domestic court and Supreme Courts that will finally have the last say on that.
Yeah, so
it can end up in various ways, if taxpayers start to litigate in various member states, there's no guarantee on a unified conclusion on that. That depends, on how the member states, interpret the OECD guidance, dynamic, static, et cetera, et cetera. So that is to be seen. But it creates a lot of uncertainty, I think.
Yeah, and I think that is just one of the big challenges, is that taxpayers, advisors want tax certainty. And I mean, we just went through, and not even an exhaustive list, but a list of hopefully relevant provisions in the EU with a tremendous amount of uncertainty.
Yeah, and when you look at, for example, the administrative guidance of the OECD, it's quite uncertain how that will be implemented in the European Union, in the member states. There's quite a weak recommendation in Recital 24, it is, I think, with the directive, saying, well, this administrative guidance is a great source of inspiration or illustration or interpretation. But what we don't hear is, that member states will act and say, well, let's incorporate this administrative guidance, if there's tension with the wording of the model rules and the directive, into a additional directive in order to provide certainty to tax administrations and taxpayers in the European Union. So that is a great concern for me.
Yeah, and just it's a great point, Edwin, and something I think that listeners should be aware. So when the directive was passed based on the model rules and commentary, full stop. There was no administrative guidance at this point. So we've already gotten, it's roughly May 2023 when this will go on air. And we obviously have had one round of administrative guidance, which certainly made substantive changes to the model rules and commentary. We hear that we could get at least another 1 or 2 rounds of administrative guidance before the end of 2023. Obviously, those are not included within the directive, and so there's question: will the implementing jurisdictions in the EU just take what's specifically in the directive? Do they incorporate the additional administrative guidance? And then, of course, depending on what the legislative process is for every jurisdiction, they may have to get their rules out before the final administrative guidance comes out.
Yeah, and I hope, that member states will be sensible and say, well, if there's administrative guidance that, is not a direct interpretation of the language of the model rules, and maybe more extensive interpretation, let's legislate that in the European Union via a new or additional directive, like we had with the DAC directives, the Directive on Administrative Corporations. We had various iterations. We're now at DAC 8, for example. So why not, have a Pillar 2 next version in order to incorporate this administrative guidance? And the only thing that is secured is the application of the safe harbor rules, because that is in Article 32 of the directive. But the rest of the administrative guidance, it's really a question mark how member states will implement this, how they will interpret this, but also how will courts at the end of the day interpret this. This could end up in a bigger chaos than we're even in right now, and even bigger complexities and uncertainties for taxpayers than we see right now. So
it's an interesting thought and suggestion that we would need to have another directive on Pillar 2 to incorporate that administrative guidance, particularly given how well that the first round went. And
that will be a challenge.
But a big challenge potentially to be able to get that unanimity. So Edwin, any advice, just kind of general advice for taxpayers? I mean, there's so much going on. It's amazing. I mean, there's international tax has always been a very dynamic field. It was one of the reasons I get into it. It's why I really enjoy it. But And listen, I am a steady reader of all things international tax, and it's just really challenging to stay caught up with all these various initiatives. And what advice do you have for taxpayers, and maybe not even just from an EU perspective, but just as an international tax advisor?
Yeah, pay attention to the EU agenda. It's important. I think it can be a catalyst for developments also outside the EU. For example, look at Australia, who has come up now with very far-going public country-by-country reporting legislation. But also there's some initiatives that do not have tax, in the acronym, but have a relationship with tax. For example, the Corporate Sustainability Reporting Directive. There's a tax angle to it too. So the impact of the EU agenda on taxpayers and clients is huge, I think. And well, we have a good team. We can present everything that's happening in the EU to clients, so to make sure that they're aware of what's happening and what could have a consequence for them doing business in the European Union.
Yeah,
it's overwhelming.
And I think the advice that I would give to taxpayers as well as advisors is get involved in the process. Like when these policymakers, and you worked in the Dutch Ministry of Finance, you want to hear from taxpayers, you want to hear from advisors. What are the issues that we're missing? And I think that particularly in the EU, through the process that you described, there is that opportunity for taxpayers.
And despite, that's a sort of contradiction, despite the activist tone of voice sometimes of the Commission, there's really interest in the positions of business. So be involved indeed in the submissions, in the consultations, and make sure that your voice is heard directly or via AmCham or via Business Europe, but make sure that your voice and concerns, ideas are heard. I think that's very important.
All right, well, great advice, and I think a perfect way to end it. And as we continue to follow these developments, Edmund, we'll have you back on to see where we end up with BEFIT, amongst others. And if we end up with the CCCTB 3.0, you'll hear about it on the Cross-Border Tax Talks.
Yeah, stay tuned. Okay,
All
thanks.
Right. Well, thanks for tuning in to this week's episode of the Cross-Border Tax Talks. Thank you, Edwin Visser, PwC's European Tax Policy Leader. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.